Hello students, this is Professor Tanuja Bhati from Jain College of Engineering, Belgavi. Today we will be going through unit number 3, module 3, that is sources of financing and cost of capital. So this unit covers two parts, mainly the sources of financing, which is only theory, and the cost of capital, which consists of theory and problems. So I'll be dividing this module into two parts. So in sources of financing, we will be seeing what are shares, debentures, term loans, lease financing, hybrid financing, venture capital, angel investing, private equity, warrants and convertibles. In the later part, we will be seeing the cost of capital. Once we have received the capital through these sources, what is the cost involved to receive the capital is the calculation part, which covers theory and problems. So we'll be seeing cost of debenture capital, cost of preferential capital, cost of term loans, cost of equity capital under both the approaches, that is dividend discounting approach and CAPM approach, cost of retained earnings, determination of weighted average cost of capital, marginal cost of capital, and in this unit, case study can be asked on WACC. WACC is nothing but weighted average cost of capital. So, we will be starting first with the sources of finance. Now, what do you mean by the source of financing? Source of financing means the source through which a company can raise finance in order to meet its needs relating to short-term finance, medium-term finance, and long-term finance. Every company, in order to run its business, it requires finance. Finance is an essential element for any company in order to run its business. So, the sources through which a company can get the finance is nothing but sources of finance. But there are different kinds of needs of finance by the company. So, the needs can be divided into short-term needs, medium-term needs, and long-term needs of finance. So, short-term financial needs, medium-term financial needs and long-term financial needs. What are these? We'll just go through it. Now, any amount of finance required by the company for a period of 1 year comes under the need of short-term finance. Where a company requires a finance for more than 1 year and less than 5 years, it comes under medium-term finance. And where a company requires finance for more than 5 years, it comes under long-term financial needs. Now, why is a short-term finance required by the company? It is required by the company in order to meet the working capital needs. Why is a medium-term finance required by the company? It is required by the company in order to purchase an asset. And why is long-term finance required by the company? In order to purchase the fixed assets and make investments. So some examples of short-term finances: meeting daily expenses, purchases of raw material. Some example of medium-term finances: purchase of plant and machinery. An example for long-term finances: land and building, furniture and fixtures. That is purchase of land and building and furnitures and fixtures. Now, we have already understood in our previous slides that what is the source of finance. Now, what are the sources through which a company can raise the finance? If a company wants finance, these are the different types of sources through which a company can raise the finance, can get the finance. That is through shares, through the issue of shares, through the issue of debentures, by taking a term loan, by lease financing, by hybrid financing, by venture capital, by angel investing, by private equity, and by warrants and convertibles. Now, what are all these? We will be seeing in our next slide. Now, what are shares? Share is nothing but it is an indivisible unit of a capital expressing the ownership relationship between the company and the shareholder. The denominated value of a share is its face value, and the total of the face value of the issued shares represent the capital of the company. The income received from the ownership of shares is a dividend. So what is a share? When a particular company wants capital, that is wants money to start its business or to run its business, to carry on its business, so it will issue shares to the public. And when this public invests the money, okay, into the company by the way of they get shares in return from the company, they are said to be the shareholders or the owners of the company. And in return, they get a reward that is nothing but dividend, is nothing but a reward that these shareholders are receiving for the amount that they have invested in the company. So now this company is raising the finance with the help of issue of shares. There are two types of shares, equity shares and preference shares. We'll see what are these two. Equity shares. They are the ordinary shares of the company. They form part of ownership of the shareholders of company. A company can issue any type of shares, equity shares either or preference shares. Any person who subscribes for the equity shares and invest money into the equity shares, they become the owners of the company. Whereas in case of preference shares, these shares have preferential right over payment of dividend and repayment of capital. We have already seen that against the money invested by the public into the shares of a particular company, they get a reward named as dividend. So, and the person holding the share becomes the shareholder of the company. So, if it is a preference shareholder, they will get the dividend first when compared to the equity shareholders. And in case of repayment of capital, their capital will be repaid first. So they are having the preferential right over two things, that is payment of dividend and repayment of capital. Now what is dividend? It is nothing but reward given to the shareholders for the money that they have invested in the company. Now what is going to be the rate of dividend? In case of equity shares, it is fluctuating. There is no fixed rate of dividend given to equity shares. It keeps on fluctuating. But in case for preference shares, the rate of dividend is usually fixed. When is dividend paid to the equity shareholders? It is paid after all the liabilities are paid out. Once the debenture holders get, once the outside person's liability has been cleared, once the debenture holders liability is cleared, once the dividend is paid to the preference shareholders, the remaining profit is then given to the equity shareholders in the form of dividend. So they are the equity shareholders are the last persons to get the dividend after all the liabilities are paid off. Now, in case of preference shares, dividend is paid in prior to equity shareholders. So, before equity shareholders are being paid, preference shareholders are being paid the dividend. So, they are having preferential right over dividend, voting rights. When any decisions of the companies are to be taken, since the equity shareholders are the owners of the company, they have the voting rights in order to make the decisions relating to the company. So they have voting rights, but preference shareholders, they do not have any voting rights. Capital repayment in case of winding up. When the company is winding up, Whatever capital is invested or money is invested by the equity shareholders are repaid at the end, after the repayment of all the liabilities, after the repayment of all the money to the preference shareholders. The last repayment is made to equity shareholders. But in case of preference shareholders, preference shares are repaid over equity shares. Convertibility. Equity shares cannot be converted, whereas preference shares can be converted into equity shares. A preference shareholders can convert their preference shares into equity shares, but equity shares cannot be converted. So this was all about shares. Moving ahead to debentures. What are debentures? A debenture is a medium to long-term loan taken by a large companies to borrow money. Therefore, it is a debt instrument. See, when any company wants money or finance, it can ask the public for the finance. So when the public invests the finance into the company, okay, it is like a loan taken by the company, and in return for the amount that is invested by the public into the company gives the public a debenture instrument, that is a debt instrument. So debentures are issued by the company to the public for the amount that they have invested. It is a long term loan, it is a debt instrument, which now this loan is repayable, that is this debentures is repayable to the person holding the debentures, and this person is called as a debenture holder. So here in this image you can see that there is a person who is providing funds to the company in return is issuing debentures to him, so he is known as a debenture holder. After some specific years, the company will repay the amount back to the debenture holder along with some, like the redemption of the debentures can either be at par, premium and discount, and every year up to the repayment the debenture holder will be getting certain interest on the amount that he has lent to the company. In case of shares, the reward is dividend. In case of debentures, the reward given to the debenture holder is in the form of interest. A debenture is a medium to long-term loan taken by large companies to borrow money. Therefore, it is a debt instrument. The persons holding debentures are called the debenture holder. So, in this image, it is this person is called as a debenture holder. Debenture holders are entitled to interest. Why interest? Because they are lending the money to the company. Debenture holders do not have voting rights in the company. So these people will not have any decision making authority or power of giving a giving any decision authority in respect of the company. There are types of debentures, redeemable debentures. Redeemable debentures is which are repayable after a specific period of time. Irredeemable debentures are those debentures which are not repayable after a specific period of time. Convertible debentures are those debentures which are converted into preference shares or equity shares after a specific period of time, and non-convertible debentures are those debentures which cannot be converted into preference or equity shares after a specific period of time. Next, term loans. What are term loans? A term loan is a loan taken from a bank for a specific amount that has a specified repayment schedule, carrying either a fixed or floating rate of interest. The term loan is suitable for an established business with sound financial statements. See, any business which wants finance, any company that wants finance can even go for an option, can source its finance through term loans. Term loans mean nothing, any amount taken from the bank which has to be repaid, okay, and until its repayment, it has to pay certain interest to the bank because it is using the bank's money in the form of a loan. So bank is entitled to receive interest, either it can be at fixed rate or floating rate for any specified amount. So there is one more option for sources of financing, that is term loans. Next, lease financing. So what is lease financing? Lease financing is one of the important sources of medium and long-term financing. The owner of an asset gives another person the right to use that asset against periodical payments. So just look at this image. The owner of the asset is called as the lessor. The person who is going to use that asset is called as the lessee. So the owner is the lessor. The person who is going to use the asset is called as the lessee. Now what the owner is going to do? The owner is going to give its asset. This, suppose in this example we take a machinery, we take an example of a vehicle. So the owner is going to give a vehicle for the use to the lessee. Now in return, lessee has to pay the lessor some minimum lease payments, okay, like lease rentals for the use of the asset. So here what is happening is the owner of the asset gives another person, so another person is the lessee, the right to use that asset, the right to use this asset against periodical payments. The owner of the asset is known as lessor and the user is called as the lessee. The periodical payment made by the lessee to the lessor is known as lease rentals. Under lease financing, lessee is given the right to use the asset, but the ownership lies with the lessor. Here the lessee can only use this asset, but the ownership will still remain with the lessor. At the end of the lease contract, the asset is returned to the lessor, or an option is given to the lessee either to purchase the asset or to renew the lease agreement. So what happens at the end of the lease agreement? Suppose the lease agreement is given for a period of 15 years. After 15 years, what will happen? There will be two options left. Either this asset that is used by the lessee can be returned back to the lessor, or the lessee can purchase this asset, or the lessee can renew the lease agreement. Next, hybrid financing. Hybrid financing instruments are those sources of finance which possesses characteristics of both equity and debt. Hybrid financing instruments are preference shares, convertibles, debentures, warrants, options, etc. Like debt has fixed rate interest rate, preference shares have fixed dividend and they also have preference of payment at the time of liquidation, just as debt holder gets. They do not have any say in the management in the form of voting rights. Also, they do not have any share in the residual profits. So, students, just pay attention that hybrid financing are nothing but they are financial instruments of like a source of finance that are generally considered as an combination of both debt as well as equity. You all know what is debt and you all know what is equity by now. So they are the firms, investors or financial institution. What they do is they create a hybrid financial products that combine the elements of both equity and debt. They have the characteristics of both a debt as well as an equity. So hybrid financing is a combination of both equity and debt. So like a debt has a fixed rate of interest, okay, and the preference shareholders have fixed dividend. So a combination, and they also have a preference time at the payment of liquidation just as debt holder gets, and they do not have voting rights. So just as a combination of the debt as well as equity, a combination of both, is nothing but a hybrid financing. Next, venture capital. What is the meaning of venture capital? Venture capital is the money invested in businesses that are emerging or in startups or in small businesses. These companies have a huge potential to grow. The people who invest this money are called venture capitalists. The venture capital investment is made when the venture capitalist buys shares of such company and becomes a financial partner in the business. Venture capital typically comes from institutional investors and high net worth individuals and is pooled together by dedicated investment firms. That is, venture capital firms comprise a group of professional investors. So, everyone pay attention. What is exactly venture capital? It is a combination of two things, that is venture and a capital. Venture implies a course of action and capital denotes the resource. So everyone pay attention. Usually this venture capital is usually invested in such types of startups which have already started and they have started getting certain revenue. So what happens? There are certain institutions, okay, like when which are called as venture capital firms. So what do venture capital firms do? They take the money from professional investors and then they invest in startups that have huge potential to grow. So since they are investing in the startups which are already started getting certain revenue, the risk will be there, but it will be to a lower level of risk involved. And when this professional investors invest in this venture capital firms, they become the financial partner in the business. And the person who invests is called as venture capitalist. Next, what is angel investing? Angel investors, sometimes known as business angels, are individuals who invest their personal financing in a startup. Now, in venture capital, what did we see? We see that there are professional investors who want to invest. So they directly don't invest their money into the startups. They give it to a venture capital firm, and that venture capital firm will then put it into the startups. Here, the angel investors will this is an angel investor, he will directly finance his own money into the startup. And this angel investor will invest into a startup which has just started. So here the risk is very high when compared to venture capital, because in venture capital people invest once the startup is started getting a little amount of revenue. Now, angels are rich, often influential individual who choose to invest in high potential companies in exchange for an equity stake. So once what is the intention of this angel investors? That once the company is doing extremely good, okay, they will want some ownership in this company. So they will want an equity stake in the company in which they have invested. As they are investing their money, and there is always an inherent risk. See, when they are investing the money, when there is a huge amount of risk involved, obviously they will want an ownership stake, that is equity stake in the company. It's unlikely, highly unlikely, that an angel will invest in a business owner who isn't willing to give away the part of their company. So did you all understand the difference between a venture capital and angel investing? In venture capital, all the investors will first invest into the venture capital firm, and then the money is invested into the startups which has already started getting a amount of revenue. But in angel investing, the person individually invest his own money into the startup, and here the risk involved is too very high because it is just a startup, and you know that 90% of startups usually fail. So here the risk involved is high. Since the risk involved is high, this person, that is angel investor, will want the ownership stake in the company once the company starts doing better. Next source of finance is private equity. What is private equity? It is equity, that is shares representing the ownership of or an interest in an entity that is not publicly listed or traded. So here private equity is nothing but getting the ownership in a company which is not publicly listed. A private equity investment will generally be made by a private equity firm or an angel investor. Each of these categories of investors has its own set of goals, preferences, investment strategies. All investors provide working capital to the target company for its expansion, innovation or product development, or restructuring of the company's operation, ownership, or management. So, in short, it is nothing but investing into a company which is not publicly trading, okay, in order to meet the working capital needs of the company, or either for the expansion of the company or product development of the company, etc. Next, last part is warrants and convertible. So what are warrants and convertibles? They are nothing but the securities that are offered by the company to attract the investors in order to raise the finance. So warrants are nothing but they allow the investors to purchase the ordinary shares. So when we say ordinary shares, it is nothing but it is the equity shares. So warrants are nothing but they are allowing, a company will allow the investor to purchase ordinary shares at a fixed price over a fixed period of time or to perpetuity. The price of the shares is usually higher than the market price at the time of issue. And what are convertibles? Convertibles are long-term securities which can be changed into another type of security such as common stock. So we'll just go through this. Warrants are long-term securities. They grant investors the right to purchase shares at a fixed price. The price at which the underlying security can be bought or sold is referred to as exercise price or strike price. So what is the meaning of exercise price or stock price? The price at which the holder of the warrants. See, the company issues the warrants. The one who purchases the warrant becomes the holder of warrant. So what is exercise price? The price at which the holder of the warrants can purchase a fixed number of shares of the common stock, that is the equity, is normally referred as the exercise price. So the price at which the warrant holder will purchase the number of shares at a particular price, that price is called as the exercise price or strike price. Warrant that gives the right to buy a security are known as call warrants, and warrants that give the right to sell a security are known as put warrants. Next are convertibles. So what are convertibles? The convertibles are a long-term securities that can be changed into another type of securities such as common stock. What does this mean? This means that a convertible security is one that may be exchanged for a common stock by the holder and in even some case by the issuer according to some terms that are agreed upon. For example, there can be convertible bonds, that is bonds that can be converted into, bonds are nothing but debentures, similar to debentures, so that can be converted into shares or convertible preferred stock. And by purchasing a convertible bond, the investor can still receive returns as an additional option of converting that bond into the shares if the share price increases enough to make it worthwhile. So convertibles is nothing but a specified number of shares of stock are received by the holder of the convertible security when he or she makes the exchange. So this is convertibles means where there is holding a when the holder is holding a particular security which can be converted from one form to another form. And warrants is nothing but where the investor or the warrant holder is given the right to purchase the shares at a fixed price. So if the warrant holder is given a right to buy a security, it is known as call warrant, and sell the security is known as put warrant. So thank you students. We have completed part A of module 3, that is sources of finance, which was completely theory, and theory notes are already given to you all. So I request you all to go through the theory notes for the sources of finance, the advantages and disadvantages of each source of finance that has been explained today. In my notes, it is very self-explanatory. If any doubts, you all can contact me. Next part we will be doing on cost of capital, which consists of problems as well as theory. Thank you.